In the autumn of 1973, the foundational mathematics of the global economy were violently rewritten. For decades, the post-war industrial boom had been fueled by an unspoken assumption of infinite, practically free energy. But virtually overnight, the price of a barrel of crude oil quadrupled, shattering the illusion of stability and exposing the fragile architecture of international trade. How could the control of a single subterranean resource paralyze the most advanced economies on Earth, transforming a physical commodity into the ultimate instrument of geopolitical leverage? The answer lies in a meticulously orchestrated disruption that revealed the hidden matrix of global power. The catalyst for this unprecedented economic shock was forged in the fires of the Yom Kippur War. In October 1973, a coalition of Arab states launched a surprise military offensive against Israel, seeking to reclaim territories lost in previous conflicts. As the geopolitical landscape fractured, the United States initiated Operation Nickel Grass, a massive strategic airlift to supply the Israeli military. This intervention crossed a critical threshold, triggering a retaliatory response that would bypass traditional military theaters and strike directly at the economic arteries of the Western world. The Organization of Arab Petroleum Exporting Countries, a powerful bloc within the broader OPEC cartel, recognized an opportunity to weaponize their primary export. They declared the 1973 oil embargo against the United States and other nations that supported Israel, simultaneously mandating deep cuts in petroleum production. Resource control was no longer merely a matter of commercial enterprise. It had been explicitly forged into a weapon of international diplomacy. The cartel had calculated that the West's insatiable demand for energy was its greatest systemic vulnerability, a pressure point that could force a radical reshaping of global power dynamics. The mechanics of the embargo were brutally effective. By artificially restricting the global supply against an inelastic demand curve, the producers engineered an immediate and catastrophic price discovery event. The cost per barrel skyrocketed from roughly $3 to nearly $12 in a matter of months. Because modern industrial economies required a fixed baseline of energy simply to function, buyers could not easily substitute or forego consumption. They were forced to absorb the massive price premium, resulting in an instantaneous hemorrhage of capital from importing nations to exporting states. The shockwave hit Western economies with devastating physical and financial force. The vulnerability of nations built entirely on the assumption of cheap gasoline was laid bare in the form of sprawling lines at fuel stations, government-mandated rationing, and darkened city streets. The economic impact extended far beyond the pump, infiltrating every layer of the supply chain. Transportation costs surged, manufacturing overhead multiplied, and the price of basic agricultural goods spiked as the cost of petroleum-based fertilizers and diesel machinery became prohibitively expensive. The invisible infrastructure of daily life was suddenly visible, and it was breaking down. This cascading failure birthed a terrifying new economic anomaly known as stagflation. Prior to the 1970s oil crises, classical macroeconomic theory dictated an inverse relationship between inflation and unemployment, a principle enshrined in the Phillips curve. Policymakers believed that a stagnant economy could be stimulated by accepting slightly higher inflation, while inflation could be cooled by tolerating higher unemployment. The oil shock obliterated this paradigm, simultaneously driving up prices through severe supply constraints while crushing economic growth and pushing unemployment to alarming heights. Central banks found themselves trapped in a paradox, possessing no conventional monetary tools to fight both crises at once. The sudden paradigm shift ruthlessly exposed structural inefficiencies within major industries, most notably the American automotive sector. For decades, Detroit had operated under the assumption that fuel efficiency was irrelevant, designing massive, heavy vehicles optimized for comfort and horsepower. When the cost of gasoline quadrupled, the iconic American muscle car was instantly rendered obsolete. Domestic manufacturers were paralyzed, trapped by long product development cycles and a systemic inability to rapidly pivot their massive assembly lines toward the production of smaller, economical vehicles. This corporate paralysis created a massive vacuum in the market, one that international competitors were uniquely positioned to exploit. Japanese automakers, accustomed to operating in a resource-scarce island nation, had spent years perfecting the engineering of lightweight, highly fuel-efficient engines. Companies like Honda and Toyota flooded the Western market with compact cars that perfectly matched the new economic reality. This was not merely a temporary shift in consumer preference. It was a permanent reallocation of global market share, demonstrating how external resource shocks can dictate the survival and dominance of multinational corporations. Beneath the surface of consumer distress, a historic transfer of global wealth was fundamentally rewiring the international financial system. The OPEC nations were suddenly accumulating unprecedented volumes of capital, generating massive current account surpluses that their domestic economies could not absorb. This capital required a safe harbor, leading to the creation of the petrodollar recycling system. Hundreds of billions of dollars in oil revenues were deposited into major commercial banks in London and New York, transforming these institutions into the central clearinghouses for a new era of global liquidity. The mechanics of petrodollar recycling masked profound systemic risks. Awash in fresh deposits, Western banks aggressively sought out new lending opportunities, funneling massive syndicated loans to developing nations in Latin America and Africa. These developing countries, themselves desperate for capital to pay for the suddenly exorbitant cost of imported oil, eagerly took on the debt. The financial architecture had successfully distributed the immediate shock, but it had done so by leveraging the future, weaving a complex web of sovereign debt obligations that would eventually become unsustainable. Recognizing the existential threat posed by foreign resource dependency, Western governments initiated a frantic scramble for energy independence. The United States authorized the creation of the Strategic Petroleum Reserve, a massive network of underground salt caverns designed to stockpile millions of barrels of crude oil as a buffer against future disruptions. Simultaneously, federal authorities implemented mandatory corporate average fuel economy standards, forcing automakers by law to double the efficiency of their passenger fleets. The state was compelling the market to internalize the cost of geopolitical risk. The permanent elevation of global oil prices also fundamentally altered the calculus of energy exploration. Projects that were previously deemed too expensive or technologically daunting suddenly became economically viable under the new price paradigm. Capital flooded into the development of non-OPEC oil sources, accelerating the construction of the Trans-Alaska pipeline system and driving massive offshore drilling operations in the unforgiving environment of the North Sea. High prices had incentivized the creation of new supply channels, slowly beginning to erode the cartel's absolute monopoly over marginal production. Yet, just as the global economy began to adapt to this new equilibrium, a second structural fracture occurred. The 1979 Iranian Revolution overthrew the Shah, plunging a critical node of the global energy network into chaos. Oil sector workers went on strike, and Iranian production plummeted, removing millions of barrels per day from the international market. The ghost of the previous crisis immediately haunted investor sentiment, triggering a secondary panic that proved even more economically destructive than the first. The defining characteristic of the 1979 shock was its deeply psychological nature. While the actual net reduction in global oil supply was relatively small, the trauma of the embargo years drove an irrational market response. Refineries, corporations, and national governments engaged in aggressive panic buying and hoarding, desperate to secure inventory at any cost. This artificial demand surge exacerbated the physical shortage, driving the price of crude oil past $39 a barrel and unleashing a second, more virulent wave of global inflation. The relentless persistence of stagflation forced a radical and brutal shift in macroeconomic policy. In 1979, Paul Volcker assumed leadership of the Federal Reserve with a mandate to break the back of entrenched inflation, regardless of the short-term economic collateral damage. Volcker abandoned the gradualist approaches of his predecessors and engineered a deliberate, aggressive contraction of the money supply. He pushed the federal funds rate to unprecedented heights, peaking at over 20% in 1981, prioritizing the stabilization of the currency over the preservation of employment. The cost of the Volcker shock was devastatingly high. The induced recession of the early 1980s crushed industrial output and sent unemployment soaring, but the most severe consequences manifested in the developing world. The massive syndicated loans that had been distributed during the era of petrodollar recycling were predominantly structured with floating interest rates. As the Federal Reserve hiked rates to combat domestic inflation, the debt servicing costs for nations across Latin America exploded, triggering a catastrophic wave of sovereign defaults that nearly collapsed the international banking system. By the mid-1980s, the immense power wielded by the oil cartel began to fracture under the weight of fundamental economic laws. The artificially high prices sustained throughout the 1970s had successfully suppressed demand through mandated efficiency and conservation, while simultaneously bringing massive new non-OPEC supplies online. The market was suddenly facing a severe supply glut. Unable to maintain internal discipline or agree on production quotas, the cartel lost its grip on the market, leading to a spectacular collapse in prices in 1986. The weapon of resource control had ultimately turned on its wielders. The geopolitical and economic impact of the decade permanently altered the trajectory of modern history. The era proved unequivocally that the global economy was a tightly coupled, highly vulnerable network where a disruption in one node could trigger cascading systemic failures across the entire matrix. Energy was no longer viewed as a simple commodity to be traded on the margins. It was recognized as the foundational variable in every macroeconomic equation, a critical input that dictated the baseline cost of human civilization. This stark realization led to the permanent militarization of energy security. The formulation of the Carter Doctrine in 1980 explicitly stated that the United States would use military force, if necessary, to defend its national interests in the Persian Gulf. The free flow of petroleum was officially designated as a matter of supreme national security, deeply entangling Western military apparatuses in the complex and volatile geopolitics of the Middle East for the next half-century. The architecture of global defense was realigned to protect the arteries of global commerce. The ultimate legacy of the decade was a profound ideological transition. The crises shattered the post-war Keynesian consensus, proving that governments could not simply spend their way out of deep structural supply-side shocks. This intellectual vacuum paved the way for the rise of neoliberalism, an economic philosophy that championed deregulation, privatization, and the supremacy of free markets. The trauma of stagflation convinced a generation of policymakers that central planning was inherently flawed, shifting the balance of power away from the state and toward global financial institutions. In the aftermath of the cartel's dominance, the mechanism of price discovery underwent a radical transformation. To hedge against the extreme volatility witnessed during the crises, financial markets developed crude oil futures contracts in the early 1980s. The power to determine the price of the world's most critical resource shifted from the secretive boardrooms of state-owned enterprises to the open trading floors of mercantile exchanges. The financialization of commodities created a new layer of abstraction where paper barrels traded hands millions of times before a single drop of physical oil was ever extracted from the ground. The 1970s oil crises remain the ultimate masterclass in systemic interconnectedness. They revealed the hidden matrix of incentives, vulnerabilities, and power structures that govern the modern world. The events of that decade demonstrated that true geopolitical dominance requires more than just military superiority. It demands absolute mastery over the invisible flows of energy and capital that sustain the global economy. By weaponizing a fundamental resource, a coalition of developing nations forced the most powerful empires on Earth to confront their own fragility, forever reshaping the intricate balance of wealth and power.